Hi everyone, I'm Lorenzo Di Mattia, manager of Hedge Investibila Macro Fund. I wanted to tell you what we have done in June and give you the outlook for the rest of the year. June was a positive month, although small. We were up about 30 basis points. We've been expecting a correction, especially in the factors called beta and small. Let me explain this to you. We expected a correction where the small caps with balance sheet exposed to the economic cycle, as well as the high volatility stocks, momentum stocks, the high leverage stocks would start to decline as they usually do at a late stage. And we do believe we are in a late stage of the bull market and the economic cycle. More the bull market actually, because the market peaks many months and sometimes even more than a year before the economy peaks. We expect the correction. It's a classic bubble where valuations are all-time high, and yes, earnings are strong, but estimates are so high, and most of the signs that the bubble is toward the end are there. The most speculative areas like the cryptocurrencies, the SPACs, and the most speculative areas of the software space have been correcting already. We're talking about, down 20, 30, 40, even 50% for many issues. And that's how it starts. In 2000, we've seen biotech, which was the most speculative area, started to collapse in February. NASDAQ started to go down in March, April, and S&P was still up at the highs in September, and it started to go down in September. So we're just seeing the speculative areas and the high beta and smaller companies entering a bear market already, and we are there already, and more stocks will follow. In fact, about 90% of the U.S. equity market did not make new highs in the past couple of months. Only very few mega cap tech stocks, and that's obviously good for the indices, but is a bad sign. In terms of interest rates, we don't really expect a big pickup, although from here we can see 1.6 or 1.7 again. But as all the bull market and all the big corrections, they are associated with peak economic cycle, the peak growth, and that's where we are, we believe. So rates before a really serious correction are probably going to go down, and that's what we've seen. It's true that there is a pickup in rates, but we might have seen that already from 50 basis points to 1.7, and now we might have another test of the highs. But overall, we have big stimulus in terms of fiscal stimulus, in terms of central bank balance sheet expansion. A few central banks in the world have already started to tighten, to taper their quantitative easing, and we will see more of those. Plus, the economy is not fully reopening yet. The virus is still around, and the Delta variant is likely to spread in Europe. So we have several forces, and then the liquidity and the issuing of new stocks, new high yields, new cryptocurrencies it's massive. It's the highest ever. In fact, in the first 6 months, we reached issuing that's twice as much as the whole year 2000, which was the highest basically in history up to that point. This is sucking up all the liquidity. Liquidity has been huge, and there's probably a lot left still, but the pace at which it's sucked up by all these new issues, it's incredible. It's unprecedented. So we are building short positions, first of all, in most vulnerable areas of the market, which they have started to go down already, but they will expand. And we will occasionally also buy puts on larger caps or indices like the S&P and the NASDAQ. We started July pretty well, On the top of that, we expect the US dollar to rally a little more, which would add to the risk-off phase. And it's pretty exciting for the macro strategy from here, because we're really in front of a major turning point. Thank you very much.